Hello guys, and welcome back again to another episode of the Babylonians Crypto channel. Today we are going to talk about some basic yield farming strategies and what you can do on the Terra ecosystem. So this video is for people who have bought Luna or just heard about Terra in general, but doesn't know where or how to get started. So if you are interested, please stay on. Before that, here is some disclaimer. This channel is just for educational purposes and it's not a call to buy or sell any cryptocurrencies. I'm not a financial advisor, and please do your own due diligence before putting your money into crypto. This is an overview guide that I have compiled. There are 10 common strategies that you can choose to farm yields on Terra here. And it is broken down between the passive and active approach. And the risk here is defined by the potential of your capital downside. So the green shaded ones here that I have highlighted have the lowest risk since you only deal with cash or stocks. And probably that is one thing that most people are not aware of, and that is you can actually do all these things without even having to invest or expose yourself to cryptocurrencies. So anything that is not green here are cryptocurrencies, and their price correlates highly with the price of Bitcoin and also the volatility of Bitcoins. And on the left column, you can see that is the risk level profile as well as the estimated rewards that you can get. So just play around and explore and see what suits you and play it according to your own style or investment personality. I've also done up a cheat sheet a few months back, but it is still relevant as of today. So this is more for the active approach, which involves borrowing to earn higher yields. So you are stacking yields on top of each other. And later I'll go through how to play each one of these routes here later in this video, so you can see how it works. This is the first strategy, which is just to deposit your UST into Anchor. And this is the lowest risk play. So the idea here is you just deposit some cash into Anchor and earn a fixed interest rate of 20%. But that has recently come down because a lot of borrowers have been liquidated. But generally this strategy is for someone who is just looking for a place to park your cash, and you are sick and tired of the bank paying you 0.05%. But you're also not interested in investing in cryptocurrencies. You just want to park your cash that gives you higher yield than the bank. And if this fits your profile, then welcome to Anchor. And if you want to check how they pay you this 20%, I have done a lot of Anchor videos. You can watch them in detail if you are keen. So it's very simple. How you do it is you just buy UST, you deposit into Anchor. Let's say you have $1,000, you deposit into Anchor. And right now the interest rate 18%, you get 180 by the end of the year. That's how it works. So to show you a demonstration, just come to the app Anchor protocol. But you first need to get your UST, and once you have your UST available, just come over to the Earn tab and click on deposit. Then just deposit whatever amount that you want to deposit. You can also withdraw out your capital. There's no lockout period or no minimum capital required. Just deposit and withdraw anytime you want. So it's that simple. The second strategy is to buy stocks or provide liquidity pool of the stocks that you buy on Mirror. And the profile of these people will be someone that is interested in stocks and they want to earn cash flow. They want to earn yields on their stocks. So traditionally, you can only buy dividend stocks to earn dividends. But right now, you can buy any stocks, even growth stocks like Tesla or Coinbase or Airbnb, Twitter, and you actually have this opportunity to earn 50 to 60% yields on it. Again, if your first thought is how is that even possible, please read out more about how DEX works, how liquidity pool works, and how Mirror works. So there are two options here. The first is you just buy and hold as you would in any traditional broker, and you get the same price, gain or loss. So the only difference is Mirror is open 24/7 and you can buy fractional shares. So imagine buying $50 worth of Tesla. And option B is to buy and provide liquidity. So you buy the stock and you join a liquidity pool by providing your stock into this pool. So that means out of this $1,000 that I have, I spend $500 to buy the stock that I want, and another $500 I will leave it as my stable coin, and I will provide this liquidity, and whether the stock price goes up or goes down, I will earn fees as long as people trades on this pair. So option A gives you full price exposure to the stock, and let's say if it pumps 40%, then you earn 40%. If it goes down 40%, then you lose 40%. And option B is more skewed towards cash flow dividend investors, because you only have 50% price exposure to the stock, but you earn a consistent yield of about 50%. And remember, this yield goes up and down depending on a lot of factors, but generally you earn a steady stream of cash flow regardless of whether the stock price goes up or goes down. And how this works is you buy UST, you buy your stocks on Mirror, then you provide liquidity, then you stake your LP token, then sit back and collect the trading fees that you earn as a liquidity provider. How this works is come over to the Terra Mirror Finance, get your UST ready also, then choose any stocks that you want to buy. So let's say if I want to buy Netflix, I can just click here and buy whatever amount of Netflix I want. And if you choose option A, then you don't have to do anything else, you just hold the stock. But if you want to provide liquidity, then come over to the pool, select the stocks that you bought, and also select the equivalent amount of UST and click on provide. Once you click on provide, then come over to the stake tab and stake your LP token for whatever stocks that you bought. So you can see that these are some of the APR yields that you can earn for these stocks that are trading on Mirror. The third strategy is just to stake on Terra Station. This is for the Luna bulls. So if you have Luna tokens, you are long-term bull on Luna, and you don't really want to do anything complicated. You just want to hold passively and collect dividends. So if this suits your profile, then just stake your Luna on Terra Station. So the formula for the staking rewards for Luna is the Chai transaction fees plus the protocol transaction fees plus the swap fees, which will be coming soon after the Columbus 5 upgrade. And you also receive additional airdrops for staking your Luna. Right now the rewards is about 16%, so you earn about $160 for every $1,000 put inside. So how this works is come over to the Terra Station. You can either go to the web version or you download it and go to the staking tab and click on any validator that you want to stake and just stake your Luna. That's all that you have to do to stake Luna. Next is governance staking. So governance staking is for people who are bullish on Anchor or Mirror protocols. So they are making a focus bet on the individual protocols rather than buying Luna, which is a bet on the entire ecosystem. So if this profile suits you, then you just buy Anchor or Mirror tokens and simply stake them on governance, which will auto compound for you. So how this works is you just buy Anchor or Mirror tokens. So let's say if you are bullish on Anchor, you can buy Anchor on Terra Swap, or either that on Terra Station, the Terra Swap function. Both uses the same. So you can only buy these tokens with UST. So you need to get UST in the first place. And once you get these tokens, just come over to the Govern tab and stake. So if you are bullish on Anchor, you can just stake your Anchor tokens. And they're only paying about 3% right now. And if you are bullish on Mirror, then you can stake your Mirror token under the governance tab over here. Next is borrow plus earn. So this is where it gets a little bit more advanced because it introduces another layer or stack of yield, which is borrowing. Because right now you're getting paid to borrow on Anchor, and you can use this money that you have borrowed to do all the things that we have discussed in the last few slides. So think of it as you borrow money and you earn the first stack of yields over there. Then you use the money that you have borrowed to do something else and earn additional yields on top of it. So this strategy is for people who want higher yields, but yet they are risk adverse and they are conservative. So what you can do is you borrow money on Anchor, then you deposit your money into Anchor again to earn that 20% yield. And in the event that Luna price starts crashing, you can withdraw out your deposits and repay your loan at any point in time. So here is a quick walkthrough of how it works. Let's say you have $1,000, you take out a loan. You can only borrow up to a maximum 50% of your collateral value. So that means you can only borrow $500 at most. But let's say for this example, we want to borrow 25%, so $250, and I'll be earning 260% yield because I'm getting paid to borrow on Anchor right now, and that is the first layer, the first stack. So this $250, I'll be earning $650 on my first stack. Then I use that $250 and deposit it into Anchor. But do keep in mind that borrowing is highly risky because you risk the chance of your collateral getting liquidated at a discount. So please understand how Anchor works, how the borrowing protocol works before getting yourself into this. So how this works in Anchor is you just come over to the borrow tab, but first you need to get Luna because you have to convert your Luna into bonded Luna. So you can do so by going to the bond and mint, then convert whatever amount of Luna you want. Then once you have that B Luna, then you come over to the borrow tab, click on provide, click on the amount of B Luna. So this B Luna is bonded Luna, which means you are using Luna as a collateral to put as collateral into Anchor. And once your B Luna is inside, you can click on borrow and select how much you want to borrow. So you can see right now that you are being paid 260% to borrow, because right now Anchor is short of borrowers. You can see that this green line is the deposit and the black line is the borrowing, and right now they are short of borrowers, and that's why they are incentivizing borrowers to put down collaterals and borrow more money. So once you borrow your money, your wallet UST would increase immediately, and once you got your money, that $250, just come over to earn, click on deposit and deposit that money into Anchor Earn over here to earn this additional 18%. So remember just now we mentioned that you are just adding new stack of use, and that is how it works. So the base layer is borrowing, and the strategy that we mentioned just now goes through this path, which is buy Luna, mint to B Luna, provide B Luna as collateral, borrow UST, then you deposit UST into Earn. And the other strategies that I will talk about in the next few slides will follow the same, which is the borrowing process will be the same. And the only difference is what do you do with the borrowed money. So for someone who is conservative, they can just deposit that borrowed money into Anchor Earn. But if you are bullish on Anchor protocol or Mirror protocol or Luna, then there are other places that you can explore. So this strategy is the borrow plus Anchor strategy, and this is for people who are bullish on Anchor. So instead of putting your money into the fixed deposit in Anchor and earn that 20%, you use your money to make a bullish bet on Anchor protocol. So there are two options you can do here. First is you buy the Anchor tokens, then you stake them in the governance as I have showed you earlier, or either that you buy Anchor tokens and provide liquidity to earn this 60% yield for doing that. So your total rewards would be first the borrow yield, which is how much you borrow, how much you are getting paid to borrow, and that's $250 times 260% as you have seen just now. Then you use this $250 to do choose option A or option B. So option B gives you full price exposure to Anchor tokens, and option A is more for cash flow investors, just want to collect the yields by being a liquidity provider. So how this works again is the same. You have to first borrow your money here, and once you borrow your money, you have to buy some Anchor tokens, and you either stake it here or you provide liquidity pool over here. So if you want to provide liquidity, just click on this and just provide whatever amount of Anchor tokens that you have and click stake on the LP token for your liquidity pool. Next is the borrow plus mirror strategy. So this is exactly the same as the previous one. The only difference is one is Anchor token and one is mirror token. So if you are bullish on anchor, then go for the previous strategy. If you are bullish on mirror, then go for this strategy. And concept is same. You borrow money, you use the money that you borrowed to buy mirror tokens, and you can either stake your mirror tokens, or either that you provide liquidity pool on your mirror tokens. So how this works is go to the mirror tab here, and if you want to stake your mirror 100%, click on go to governance and click on stake. And if you want to provide liquidity pool for your mirror token, then come over to pool and select your asset to be mirror. And once you're done with this, then stake your mirror USD LP into here and earn this 70% APR use over here. So it works the same as anchor. The only difference is one is anchor token and one is mirror token. Next is borrow plus stocks strategy. So this is for people who don't like mirror and also don't like anchor, but they like stocks. They prefer to invest in the stock market because it is safer. So you can see the risk level of this is medium, which is lower than the borrow plus anchor or borrow plus mirror. So it's the same again. You borrow on anchor, but instead of using your money to buy anchor tokens or mirror tokens, now you use your money to buy stocks. And we have mentioned just now how it works. You can either buy stocks and hold, then you get full exposure to the stock price, or either that you buy stock and you provide liquidity pool. So just now I've mentioned how to do this. So if you're unsure, go back a few minutes of this video to see how to buy stocks or how to provide liquidity pool on mirror. And finally, this is for the Luna boost. So this is for people who want to stack and accumulate more Luna. So what you do here is you borrow money on anchor, then you use that money. You can either buy more Luna, and then with that Luna you can do a couple of things. So the first is you buy more Luna, then you mint your Luna into B Luna, and you put back into anchor as collateral. So by doing this, you don't earn any use because there's no APR use for doing this. But the only benefit is it decreases your loan to value ratio and your liquidation risk. So the likelihood of you getting liquidated is lower for doing this. So that's the option A. Option B is you buy Luna with your borrowed money, then you stake Luna on Terra and earn that rewards. So for example, I borrow $250, then I use that $250 to buy Luna and stake on Terra station. The risk of this is in the event when Luna price starts crashing and you want to repay your loan, you can't unstake them because it takes 21 days to unstake your Luna. So you run the risk of liquidation because now your assets are illiquid in the Terra station. And finally, the last option, option C, is just to provide the B Luna and Luna LP. And right now the yields are about 50%, so that is also a potential option that you can look at. Alright, and that's it for this video. I hope you have gained some new insights into the Terra ecosystem as well as the various yield farming strategies that you can play around with. So do experiment around with it, do explore and see which strategy suits your risk reward profile, your investment style, as well as the assets that you are comfortable holding and exposed to. On a final note, do take note that these rewards are just estimated and the APY yields go up and down depending on a lot of different factors, parameters, and ratios. For those strategies that involves providing liquidity, understand the concept of impermanent loss before entering into any pools out there. And also for those who are employing the borrowing strategies, understand how liquidation works and borrow safely. Don't ape in and try to maximize your use without first understand how all these risks works. So once again, thank you for watching this video until the end. If you want to show some support, I would highly appreciate if you can like, comment, subscribe, and share this video out. And I'll see you in the next video. Bye!